Good afternoon, members, and welcome to the Fat Profits macro webinar entitled Knock Knock. It's Thursday, 3rd of August, and today's webinar is definitely going to be an interesting one, especially with the surprise downgrade by the Fitch rating on US sovereign debt. And I'm sure many of you have questions, but first we can't start without the introductions. So for today, I'm your host, Andre Abieres, and joining me are two of the sharpest guys in the company. Of course, our founder and chief investment officer himself, Angus Geddes. Welcome, Angus. How are you?
Hi, Andre. Always good to be here on a Thursday for the Fat Profits webinar. Good.
That's right. And great to have you on board. And Patrick Ganley, our chief operating officer. How are you, Pat?
I'm great, Andre. Thanks for having me today, and I'm looking forward to the webinar today. And I think we've got a lot of interesting things to talk about, and we hope everybody gets some value out of the presentation today.
Sure. Awesome. All right. So before we start, let's go over the usual housekeeping. Disclaimer: all our presentations are general information only and should not be construed as personal advice. If you are in need of specific or personal financial advice, please contact your financial planner or advisor. And of course, past performance is no indicator of future performance. All right, so now toward the end of today's webinar, we have our usual Q&A session, and you can ask one question apiece. I suggest you type in your questions as they come to mind. You can find that in the submenu here, as indicated by the orange arrow, and we'll try to address them all as time permits. In case you can't hear us, please call the toll-free 1-300 number at the bottom of the screen here. I'm sure our staff at the office would be happy to help. All right. Now, let's look at the market snapshot this week. Angus, turning this over to you.
Yeah, so a bit of pressure coming through on the stock markets on Wednesday, and we can see, the major indices in the US were down. Obviously, the selling in the United States was really sort of centered and focused on a lot of those technology stocks. Some of the mega caps that have led the rally for most of this year all came under a bit of pressure. And, as the crow flies today, I don't think there's sort of too much rhetoric around this other than the fact that the market probably needed a bit of a breather. And we'll get into that a little bit later on in the webinar. We've also seen a bit of upward pressure in Shanghai and Tokyo, the Shanghai Composite and the Nikkei both up, although I'd be expecting the numbers to be on the downside today, given there's a bit of selling in those markets. Hello.
All right. So here we have the NASDAQ 100 chart.
Yeah, I mean, if we look at this chart, we can see the uptrend that's been underway now in the NASDAQ 100, for the last 6 months. It's nice and consistent. The index has been sort of, rising in a consistent way. It's above the 50-day moving average. And that sell-off last night sort of really just brings the index back to a key support level at 15,200. Close to the 50-day moving average and that 6-month uptrend. So nothing really to worry about. But if we saw the index push down below those levels, and I'm sort of talking around the 14,900 level, then you'd have to start sort of questioning the sustainability of that uptrend that's been in the NASDAQ 100 since October last year. And also perhaps the dominance in terms of those technology stocks and those mega cap stocks in terms of leading the market. We've been saying this for a while, Andre and Patrick, that the valuations for a lot of those companies is now sky high. They're priced to perfection. There's not a lot of room for error or disappointment. And of course, I think a defining moment for the US rally that's been underway, of course, is going to be Apple when they report tomorrow morning after the bell, or tomorrow evening in the US after the bell, Friday morning our time. I'll certainly be up early to listen to the result. And you know, given Apple now makes up sort of 8 or 9% of the S&P 500, it's got a $3 trillion market cap. The market will be not wanting to be disappointed. So, and I think that will set the course, you know, for trading in the US markets and probably the global markets, you know, over the coming few weeks.
Angus, in your view with Apple, do you think they'll have a good result, or do you think they'll disappoint?
Pat, it's hard to say because the bar of expectations has been lowered quite a lot, and so the market's braced, you know, for disappointing numbers. That's pretty much all in the price. So I think, you know, it's impossible to say whether they're going to come in with a beat or a miss. You'd probably say, look, they'll do what every other company in the S&P 500 does and talk the numbers down heading into the result and then come out with a beat. I think tomorrow it's going to be all about what they say with respect to future earnings and guidance. Because the market at the moment, you know, we've had this big rally, certainly in these big mega cap technology companies, on the expectation that the earnings trough, and you know, earnings have been coming down in the US for the last year or so. The earnings are going to trough in the June quarter. That's what's being priced in. So, you know, the market won't really like, you know, any sort of rhetoric out of the company that counters that. In other words, you know, if Apple start talking about poor trading conditions spilling over into the third and fourth quarter of this year, so that would go down badly, I would have thought. Having said that, you know, we've already had, you know, out of the Magnificent Seven, we've already had a number of strong beats. Microsoft, you know, did it. Alphabet did it. You know, so a lot of the pace has been set. So, you know, and we're nearing the end of the reporting season. But you know, a lot is hanging on the Apple result tomorrow, and you know, it's all it's going to be about where earnings are going in the next couple of quarters.
Okay, Andre.
All right. So the next slide is the U.S. 10-year bond yields.
Now, this is an important chart, and we're going to talk a little bit about what's going on in the bond market today. I mean, there's been, you know, a fair amount of damage going on in the bond market, and all the investment banks, JP Morgan, Goldman Sachs, Morgan Stanley, you know, a lot of the big investment banks and strategists at those investment banks pretty much have the consensus view that bond yields are going down. If we look at this chart, I would, you know, beg to differ and actually have the opposite view. Technically, the US 10-year bond yield is actually set up to go up, not go down. And if anything, this breakout in the 10-year yield that happened about a quarter ago, 3 months ago, which, you know, which I've been focusing on in my daily, we're seeing this upside extension, and you know, we're not too far away now from the 10-year potentially hitting 4.2%. I think the US bond yields are going higher, and they're going to drag international bond yields higher around the world. And I think this is going to be problematic for the expensive end of the stock market. You know, for those mega cap growth stocks, for you know, high priced, you know, technology, you know, companies on huge multiples, and we've seen multiple expansion this year. It hasn't been because of this, it hasn't been driven by earnings growth. It's been just PE multiples being dialed up. You know, I'm cautious on those sectors of the market, and you know, at some point we're going to see a reaction of those high priced technology and growth companies to what is manifesting itself as higher long duration or long-term bond rates. There are a number of factors for, you know, I think there's a number of reasons really why these US bond yields are going higher and dragging the rest of the world with it. I mean, firstly, this week, the big piece of news, and, hence the title, of the daily this morning, knock, knock, the big bad wolf knocking at the door. In this case, it's really been about the bond market and the Fitch rating agency downgrade, the first downgrade to US debt by a rating agency since S&P did one in, I think it was 2011. So US debt has been downgraded. And I think, what this really means is that there'll be nations such as Japan and a range of others that will be looking through their treasury reserves and potentially looking at diversifying out of US treasury bonds and US dollars. So that's one factor behind it. This rating downgrade. US debt is no longer deemed as safe as what it was yesterday, according to Fitch. Another driver is, of course, the US government's need to replenish its coffers, and they've been issuing billions and billions of treasury bonds. They need about 1.2 trillion, and here we are in July. I think the debt ceiling was resolved in June, so not even 2 months later, and the US 10-year bond yield is knocking on 4.2%. The US Treasury has a lot more Treasury bonds to issue over the course of the rest of this year to fill those coffers. So we can expect all that supply hitting the market to drive yields up as well. And of course, the other thing to worry about really is we may not have seen the last rate hike from the Fed. The market was pretty confident, several weeks ago that, the last hike was in. But, here we go again. We're getting quite strong job market data coming through. All eyes are going to be on the non-farm payrolls out on Friday. If it's a strong print, the probabilities will begin to change and go up that the Fed may not yet have finished. And of course, if they push interest rates up over there any further, it's probably going to push up the long end of the US yield curve. So that was really one of the big breaking stories this week. The other factor, of course, is what the Bank of Japan did last week. That's got significant consequences. Up until sort of last week, the Japanese bond yield on the 10-year was trading around 0.4%. The Bank of Japan had a cap at 0.5, and essentially they're no longer going to cap it at 0.5. They're going to allow it to fluctuate between, where it is at the moment and 1%. And of course, this has got quite significant implications for capital flows throughout the world. Not least being, capital flows in and out of Japan. Japan for a long time has been considered as a country to go and borrow money, where money is cheap. You can borrow, way cheaper interest rates in Japan than anywhere else in the world. So it's been a currency that, a lot of banks and financial institutions, etc., have funded, their loan books in. So this might change now, with the breakout in Japanese bond yields. And I think we've got a chart on that, haven't we, Andre? But before we move on to that chart, maybe have you got any other questions on the US debt issue with the ratings downgrade and the 10-year bond yield pushing up to 4.2?
No, I was just going to ask you, Angus, about the interest rates. I mean, obviously this points towards potentially interest rates going up. We saw a pause here in Australia. What's your view on the interest rates here in Australia and in the US? Do you think we're going higher?
Yeah, I do, Pat. I think the tail doesn't wag the dog wags the tail. And, the US is the dog, to use the analogy. And, where the US bond market goes, our bond market and every other bond market, the UK bond market, most of those other bond markets are going to follow. And, the same argument's probably true for the stock market to a lesser extent. So I do think rates are going to go higher at the long end, and I think that Australian bond yield is also in a secular bear market. I think most bond markets around the world are in secular bear markets, certainly in the developed world, and those ultra low interest rates we saw last decade won't be seen again probably in our lifetime, and the cost of money is going up. And let's not forget also, Pat, that inflation, whilst it's trending down, hasn't gone away. We've still got elevated inflation around the world, not just in the United States, but it's a problem here in Australia, it's a problem in the UK, and inflation eats into the real rate of return that you get on a bond and what you get on a bank deposit. You end up with the real rate of return, which is the nominal interest rate less the inflation rate. So I think investors are going to have to be compensated for that and for that risk, and the cost of money is going up. Now, that doesn't mean to say that some of the central banks might be getting near the end of their tightening cycles, but it's worth highlighting again that whilst the central banks can control the cost of money at the short end of the curve, i.e. the overnight cash rate, the market determines the bond yield, what a bond will yield, because it's a free market, and it's up to supply and demand on any given day that determines that, not the central bank. What the central bank does with the overnight rate has a direct bearing, but there are other factors as well. So, I do think, to answer your question, I do think the cost of money is going up.
Okay, and just one more question before we jump to the next slide. You talk a lot about Japan, and in the managed accounts and in the funds, how are you positioning that with Japan? Are you looking at certain sectors? Are you in the banks, or what are you looking at in Japan at the moment?
Look, we really like the Japanese banks. For decades they didn't make much money because Japanese interest rates were really low. Now, with interest rates rising in Japan, the Japanese banks are actually finally starting to make some real margin and get a better return on their capital. So that's probably the first factor. So the rising rates in Japan are actually a big tailwind for the Japanese banks. They're still pretty cheap, by sort of international standards. The average Japanese bank trades at about 0.68, 0.7 times price to book value, which is cheap. They were cheaper. They were definitely a lot cheaper a year ago, trading at around 0.4 times price to book when we were buying them, but they're still cheap, by international standards. Look, the other reason I like the Japanese banks is the domestic economy is pretty strong now, and you've had very low or little price growth in the housing market in Japan now for a number of decades. So the Japanese residential market can actually withstand probably quite a big increase in bond yields without actually causing any spillover problems into the domestic economy. This contrasts starkly with what's happening here in Australia, where you've got a lot of sensitivity by mortgage borrowers to cash rates and borrowing rates. So that's another factor. And I think given that the rest of the world has had a bad reaction to inflation, and it hasn't been great, the Japanese have battled deflation for 3 decades. So it stands to reason that a bit of inflation finally coming through after all these decades of deflation is actually a really good thing for the economy. And I think this is one of the major reasons why the Japanese stock market has been re-rated. So yeah, Japan's one of my favorite investment destinations, and we'll be putting more money to work in Japan should an opportunity arise in coming months and we see stocks pull back a bit.
Okay, Andre, next slide.
All right, so the next slide is on US dollar index.
Yeah, so the US dollar got a bit of a bid last night, and that I put that probably down to the fact that bond yields in the United States went up. So, you know, rising interest rate differentials between the United States and the rest of the world, you know, has a powerful impact on the dollar, and it draws in and attracts capital inflows. So I think there was a bit of that going on last night. Look, the reaction was fairly muted. It could have been more given the move that we've seen in the bond market. So I think tempering that is this Fitch downgrade. And of course, I don't think the strength in the US dollar index is going to prove lasting. I think it's going to fade over coming weeks and months. And I'm looking for the dollar index to, hit a wall of resistance at 103. I didn't think it would get through 101, but it has, and it's now traced out this this channel, this downward trending channel, as you can see on the with the blue dotted lines. And from a technical perspective, I think there's a good probability the US dollar index will hit 103, which is a resistance level, and then resume a downward path. At least that's in my playbook.
Okay, Angus, so if we're going lower in the US dollar index, where would you be positioning yourself? Commodities, gold, what do you think is going to happen from here?
Look, I like the gold. I like the commodities. I think not only will they benefit and are a natural hedge against inflation, but this big correction that we've seen this year, where commodities have come off and gone down, whilst in the stock market we've seen mega cap technology stocks, the Magnificent Seven, growth, etc. We've seen PE multiples expand, and they've benefited. I could see a situation where capital starts to get reallocated back into the commodities trade. So I like all the commodities at the moment. I think we've seen some decent, meaningful technical inflections traced out in a lot of them. Copper had a decent move to the top side this week. We've also seen some decent sort of breakouts in a number of the grains and the soft ag commodity prices. I put a chart earlier this week up of coffee, which made a record high this week. So I like the soft commodities. I also like energy, and I've been bearish on energy, Pat and Andre, as you know. Coming into the year, I was bearish, and I was looking for a $60 handle on the WTI crude oil price when we did our predictions for 23, when we did that back in December. Of course, oil did get down to 65. It's been battling a sluggish rebound in the Chinese economy, recession fears in Europe, economic slowdown and recession fears in the United States. The oil price has sort of come through that. And I think with the recalibration to a lower risk of the US having recession next year, we've seen oil actually break out on the top side of what. Can we probably put that oil price chart up? I'll keep talking. So, I am bullish on the commodities. I'm bullish on energy, and also bullish on uranium, which also looks like it's traced out a multi-year consolidation and what looks like to be a coming topside break. There's no question that the rest of the world there's an urgency for the rest of the world to re-engage with or focus on renewable energy. Climate change is real. Just look at the flooding this week in Beijing. Record floods, worst floods since I think 1872. The world's got to do something about that. And I think uranium or nuclear energy has got to play a part in that transition if we are to get away from fossil fuels as an energy source and do it, in a reasonably quick time frame as climate change probably necessitates. So very bullish on commodities across the board, really. I think there's probably a little bit of a question mark over the base metals. I think they're still going to go higher, but it may take them a little bit longer until we get some certainty over where the Chinese economy is going. But if we look at this chart here, guys, if the crude oil printing at 81.80 this week, down a little bit last night. I think that was just corrective. It's traced out a nice inflection, and so looking for further upside in the crude oil price. And of course, I really like those energy stocks. The big energy stocks, lots of free cash flow, decent dividend yields, pretty defensive. And a lot of them are doing really well. So, I like the majors in the UK. I like the big majors in the United States. I like Santos and Woodside in Australia.
So with uranium, Angus, you've been talking quite a bit about that. How would you play it? Or how would you recommend anybody that's looking to get exposure to uranium to get into that opportunity?
Yeah, okay, so I think the best way is it's an exchange traded fund listed in the United States. It's called URA. It's the Global X Uranium ETF. And that is a basket of the world's top uranium producers. I really like that ETF, Pat, because it sort of diversifies the investor away from having specific company risk. And, it gives you access to a basket. So that's what we've been buying. I also like in Australia, close to home, Paladin, which has got a major uranium mine in Namibia. It was suspended back in 2018, and it's now been brought back into production. And the company expects to have that up and running in the first quarter of next year, which is not that far away. So that's a stock play close to home.
Okay,
All right.
Andre, next chart, please.
Yeah, all right. The next one is the Aussie spot gold price.
Yeah, so bit of a knock overseas in the US to the gold stocks on Wednesday night. But I thought this chart was interesting because, the Australian spot gold price, this technical setup is very, very bullish. And I think, what we've seen in the last, over the course of this year is we've seen the Aussie dollar spot gold price trace out a decent correction. And, it's bounced off that $2,800 an ounce level quite convincingly. Lots of support there. It's now resuming an upward path, and I think we can expect a retest of the record highs at 3,100 at some point later this year. So whilst the US dollar gold price is probably looking a little bit more deflated, I still think the US dollar gold price is looking bullish. I have to say it's looking really good in Australian dollar terms. I will run a chart of the UK gold price tomorrow because I think it's always also interesting to look at spot gold and other currencies other than the US dollar. So what this means, guys, is that the Australian gold producers are really having it quite good at the moment. Things have never been better in terms of Australian spot gold prices. I know there's been some inflation on the cost side. I know costs have gone up, but a lot of the producers are getting those sort of under control and they're managing. And at sort of 3,100 an ounce, a lot of them are generating really good cash flow, and valuations are still quite cheap compared to where they were a couple of years ago. When the Australian gold index was a lot higher.
So with reporting season coming through, Angus, are you expecting good results from the gold producers here in Australia over the next couple of weeks?
I look, generally, yes, I am. It is going to be patchy. Some companies have not been as good at controlling their costs. Of course, production also plays a role. Like if there was a mine outage or weather problems, production sometimes comes in a bit short. So look, it will be patchy, but generally speaking, yes, I'm pretty upbeat about the gold producers going into reporting season.
Okay, Andre, next chart, please.
Yep. I think it's great you were talking about earnings season because the next one is the ASX 200.
Yeah, so this chart, look, there's nothing wrong with the technical setup of the ASX 200, other than to say really it's mid-range at the moment. You know, we've seen the ASX 200, you know, sort of touch that big resistance level a couple of times. It's still range bound. I'm not quite sure what the catalyst is going to be in terms of what causes a breakout, whether that to be the top side or the downside. Other than say we're still carrying a bit of cash in our portfolios. Australia is not out of the woods yet with putting out the inflationary fires. Um, Despite the RBA pause this week, we don't really quite know yet whether the RBA is done. I suspect that there'll be another hike or so coming down the line at some point. You know, given the you know, given some of those inflationary pressures within the economy. So still a little bit cautious. In terms of some of the sectors, you know, I still am quite wary of the consumer discretionary stocks, simply because, you know, consumer spending could prove to be quite erratic, you know, over the next 6 to 12 months. You know, I'm not saying that we're going to have definitively have a recession, but consumers are being increasingly cautious in terms of how they're spending. So, you know, we saw that, you know, with the softer retail sales figures coming through, you know, a week or so ago. But I think, you know, bottom line is it's not a bearish setup, but it's not a bullish setup either. We don't yet have technical confirmation which way the market's headed, and there's still a lot of uncertainty surrounding the economy. I think a bit of cash in your portfolio still makes sense at this point in time.
Okay, thanks for that, Angus. Andre, next chart. Do we have another one to go
Yep.
through?
Yeah, we have the last one for today. That is the Japanese bond yields.
Yeah, so we looked at the US 10-year bond yield, and I just thought it was worth putting this chart in because, you know, clearly the Japanese bond yield, this is actually not Japanese bonds. I'm looking at, this is actually the NASDAQ 100, guys. So that's okay. This is the chart that we had up a little bit earlier of the NASDAQ 100. You know, it's not in danger of breaking down, but we wouldn't want to see the NASDAQ 100 go much below 13,000. We may as well roll on to the next slide because I've already spoken about the NASDAQ.
All right. So we're at the you know, everyone's favorite segment, the Q&A. All right, so we have a lot of questions already. Okay, so the first one is that, you know, this member commented that, you know, this guy is closely tracking our research, and he said that he noticed a slight change in the rhetoric with regards to holding cash. His question is the general sentiment changing in regard to the global recessions, and should we be looking at getting back into investing the cash that we have been sitting on?
I think that's a good question. That is a really good question. And yes, our rhetoric has certainly changed a little bit. The narrative has changed. Look, the probability that the US has a recession has gone down in terms of next year. Most of the investment banks, the consensus amongst investors is that the US is going to escape a hard landing. I think there is probably some merit towards that. And we have redeployed a bit of cash in our portfolios, but we're still keeping some cash in there in case, you know, there is a bit of a decent correction. There's quite a few things that that would be on my shopping list, which I'm not going to go into today in the webinar, should there be a bit of a sell-off. But having said that, you know, what sort of things, what sort of stocks and sectors have we been putting money towards in the last sort of several weeks? I really still like the energy stocks. I think they're well priced, attractively priced. I think they're defensive. They're generating huge cash flows, paying decent dividends, strong balance sheets, and I like where the oil price is going. So that's one. I like the commodities generally. You know, the big materials companies, I still like those, despite, you know, the rebound in China being a little bit shaky. I think the Chinese government, which, you know, has a huge impact on commodity prices and certainly iron ore and all the base metals, I think they've really got no choice but just to keep piling on the stimulus and to get their domestic economy going. I think that's got to be good for all the commodities and certainly the base metals. Looking at over the medium to longer term, I still like the gold. I think gold stocks are going to benefit. I see the US dollar as being a good hedge against US assets as the world sees the US. I think there's going to be plenty of diversification going on there. Central banks sort of selling down maybe the US Treasury bonds and getting out of dollars, and gold will be one of the beneficiaries. I like uranium. We spoke about that today, the way to play it. I think that's a good area to be looking. And I don't mind the grains. I don't mind some of the agricultural stocks, which, have all had decent corrections this year, showing quite good value. And I think we've seen some meaningful inflections taking place in a lot of those soft commodity agricultural prices.
So that's a good question. With the rhetoric though, Angus, we're not talking about, deploying all the cash into the market at the moment. You're still looking to hold some cash, and would it be a smart way to go to try to average in at the moment, like slowly put some money back into the market, but keep your powder dry, as you would say?
Look, the market has had a decent run. We're sort of coming up to, September, October, traditionally a volatile period. You'd have to say the market's going to have a breather at some point, and there will be a bit of a pullback. So I'll probably be keeping the rest of my powder dry and waiting for that opportunity to emerge. I know we've been waiting all year, and the market is, or the US market and those Magnificent Seven stocks have really outperformed the rest of the world in a major way. But yeah, I'll probably give the next couple of months the benefit of the doubt. But we were holding a lot of cash. We have actually trimmed that cash position, and I think the oil stocks, the energy stocks, the diversified material stocks, your BHPs, your Rios, uranium. I think these all look pretty interesting at the moment. Quite happy to look at adding at these levels. Even the coal stocks have looked like they've inflected and bottomed out, after a decent 1 year correction.
All right. So the next, actually, there's a lot of questions on uranium. I think there's a lot of interest on this. They're trying to clarify the ETF you mentioned earlier. Are you referring to the Global X Uranium ETF?
Yeah, sorry, the Global X Uranium ETF, which is a basket. It's a basket of uranium producers around the world, including, they've got a decent holding in Paladin, which is, and Yellowcake, which is a UK listed uranium producer, and Paladin's obviously an Australian one. Yeah, it's a basket, and that way you've got the equity exposure without the specific individual company risk, and it's a good way, and I think it's a good way to play it.
Right, and the ticker is URA, right? Uniform Romeo Alpha.
Yeah.
Okay, great. All right, so there's actually a follow-up question on the cash holdings. This member is trying to figure out if we could quantify how much is a bit of cash.
Look, I'm not going to go into specifics other than to say that, if we were holding, say 20% cash, we're probably holding 15% as a percentage of the portfolio. But that is a very general.
Yeah.
That is very general.
Right. There's also another member here that wants your opinion on cryptocurrencies and Bitcoin in particular. Would you be able to comment on that, Angus?
Look, I think the cryptos, there are definitely a place for the cryptos, and we are in a digital age. I'm a bit old-fashioned. I like things that are heavy, that if you drop on your foot will give you a sore toe. So I'm old-fashioned in that respect. So I like gold, and I like gold equities that are actually generating cash flows and making money out of out of mining, etc. Then that's just my personal preference. But yeah, I think the cryptos have inflected. They are quite correlated. I need to point this out. They're quite correlated to the technology sector. Just as the NASDAQ 100's had a blinder this year, so is the cryptos. So they don't tend to do, excuse me, they don't tend to do as well in a risk-off world. They do fluctuate, but look, there is a role for them. I do hold some, personally, I hold some crypto in my crypto wallet. I don't hold any sort of futures or trading positions in them, but I've got some, and there for the long term.
All right, great point. So there's a question here about currency, specifically on the Aussie dollar. Could you please comment your view on the Aussie dollar?
Yeah, look, the Aussie had a bit of a knock this week, and that was entirely due to the RBA pause. And, the market was obviously looking for the Australian Central Bank to tighten and put through a rate hike. And of course, so the Aussie got bid up heading into that RBA meeting. It came off pretty quickly when they decided they were going to leave rates on hold. As a result, we've seen the Aussie fall back to about 65.4 cents. I think it'll probably find a bit of support. Interest rate differentials between the United States and Australia are probably at their widest at the moment, and I can see, I can potentially see the RBA having to put through, maybe one more hike. Maybe the Fed goes again as well. So, in other words, I think the Aussie dollar is beginning to trace out and make an important low at this point in time. Where the Aussie dollar goes, where it goes, is going to be tied to two things, I think. The first thing, the first factor really is commodity prices. And if I'm right on the outlook for commodities, and commodities are sort of going through an important inflection and start to reassert to the top side, Australia is a natural beneficiary, so you'd expect the currency to benefit from that. The second factor is if we avoid a recession, that's equally important. The United States is looking like it's going to have a soft landing or even a no recession next year. There's still a bit of a question mark over Australia. And I guess the third factor it's worth highlighting is that just as the Federal Reserve have put rates up faster than anyone else, apart from the Reserve Bank of New Zealand, they'll probably bring them down quicker. So when they start cutting, when the Fed starts cutting, which is probably going to happen next year, if inflation is brought back under control, the Fed starts cutting, they're going to be cutting much faster than Australia. So, it'll be then that the Aussie dollar really gets re-rated. So those are the three factors I'm sort of thinking about with respect to the future direction of the Australian dollar. I don't think there's too much more downside, but we wouldn't want to see it take out that big support level at 65 cents. And I'll put a chart of that up in tomorrow's daily night.
All right, so since we're almost out of time, we'll tackle two more questions. So the first one is, with the comments regarding the U.S. Credit rating downgrade and other comments earlier, do you still expect a retracement back to the levels predicted earlier in the year for the ASX?
In terms of the ASX, I think we're in a range, and I think we're in a range. Now, in terms of where the index goes, I can give you the Goldilocks scenario where, the US avoids a recession next year. China rebounds. China's recovery picks up in the second half. Commodity prices inflect higher, and a resurgence in the resources sector drives the ASX up through 7,700. I can see that scenario happening. Equally, and we're talking about the ASX 200, and that's why I like those commodity and those resource sectors in the market at the moment. Those big resource stocks that are generating, decent cash flows and paying decent dividend yields. But equally, what happens if the RBA? What happens if they don't get inflation under control? What happens if the industrial action that we're seeing, around the country is instrumental in pushing wages up, and we get caught in this ongoing wage price spiral where inflation is still a problem? The RBA can't cut rates; they're forced to go again, and that incremental rate hike pushes into a recession. So that's also a risk. So the ASX is in a range, and that's why we're still holding some cash. We really want to see which way the market's going to go and which way it's going to break out on the top side. And in the meantime, if we get some volatility in the markets and we do get a decent correction, I've got a decent shopping list in terms of stocks that I'd like to buy.
Right, great point. So, for the last question, this member is asking what do you think, or what has happened to the equity risk premium thesis and the risk-free rate? Do we Sorry?
That's a great question, Andre.
Yeah, yeah, it is.
I'd like to know the subscriber who asked that one. But yeah, really good question. I was actually thinking about this very dilemma this morning. So the equity risk premium is essentially the yield on the S&P 500 less the 10-year US 10-year bond rate. So the US bond rate is about 4%, 4.05%. The S&P 500 dividend yield is less than that. And at the moment, the equity risk premium has come in. It's at the lowest level. It's almost like investors are subscribing little in the way of risk premium to invest in the stock market, which is inherently always going to be a more risky proposition than putting your money to work in the bond market. Although a lot of people will probably disagree with that, after the absolute caning that the bond market's had in the last 12 months. So it is a bit of a dilemma, and it's causing a lot of confusion. I'll say that much. It's causing a lot of confusion about what's going on. Some of the top strategists that I follow on Wall Street, they're confused by it. At some point, all things being equal, that equity risk premium needs to reflect back towards the norm. Either US bond rates drop to restore that equity risk premium, or the dividend on the S&P 500 goes up, or through earnings growth, or the S&P 500 drops to restore it. So yeah, it's an interesting question, but then again, these times that we're going through at the moment are also quite extraordinary. Can it continue? Can the low equity risk premium continue? Well, it probably can. And I suspect as we move towards the end of the year, we'll have a greater clarity on where bond yields are going, and where the US economy is going.
Great points, great points. So, all right, so there's a lot of great questions here and great points. Before we go, do you have any last words or messages to the members? Angus?
Oh, thanks, Andre. Look, I just want to say goodbye to all the members who've taken the time to join us on the webinar. I know it's gone a little bit over our allocated time at 50 minutes, but I hope you got some value out of it. We certainly enjoy this. I will be back in a fortnight with Roger. Roger's actually away nursing a sore back. So I'll be back on this webinar in 2 weeks' time. And next Friday, I will be doing my regular, what is now becoming a regular podcast with Patrick. So I look forward to joining you next Friday as well. And I'll say bye for now.
And you, Patrick.
I'd like to say thank you. It was great to be on today. And Angus, thanks for your your thoughts on the market. I think we're in an interesting time. And I look forward to speaking to you next week on the podcast. Thank you, Andre, as well. And we'll talk soon.
All right, thank you guys. Again, I hope you all found our viewpoints useful. Remember, before you act on any of the ideas mentioned, please talk to your financial planner or advisor, exercise proper due diligence and stay active, read our reports, listen to webinars and our podcast to stay up to date. And see you all next time.